Good morning. 125 billion in 5 days. What the Fed's quiet cash injection means for commercial real estate. So over the last 5 days, the Federal Reserve has quietly pumped 125 billion into the US banking system through its Standing Repo Facility, or SRF. A move that really has caught the attention of some economists, investors, and commercial real estate professionals alike. So, beginning on October 31st was the first day. Fed alone injected 29.4 billion in that one day, which allows banks to swap treasuries for cash and ease short-term funding stress. And this liquidity boost represents the largest use of that facility since the pandemic, which signals that Jerome Powell remains hawkish on inflation and the Fed is playing defense to prevent cracks in the financial system. So, what's happening behind the scenes? While the Fed's balance sheet is shrinking due to ongoing quantitative tightening, or QT, and mastery treasury issuance, bank reserves have fallen to just 2.8 trillion, the lowest level in 4 years. And these repo operations serve as a safety valve, ensuring banks have access to short-term cash if they need it to stay afloat without selling assets at a loss. So this isn't quantitative easing or QE, but it's certainly stealth easing. So the message is clear. The Fed wants to stabilize the plumbing of the financial system without reigniting inflation, is kind of the overall thought process. So why does this matter for commercial real estate? Well, commercial property owners and investors, liquidity matters. The Fed's move signals that the credit markets are under strain, even if the headlines are saying otherwise. When short-term funding stress hits banks, lending slows, especially for higher risk sectors like commercial real estate. So this injection could offer temporary relief by keeping lending spreads from widening further. But if this becomes a recurring pattern, it suggests that the system is more fragile than it appears on the news, and that the CRE borrowers should lock in financing sooner rather than later. So what are the market implications of this? So interest rates would be for first concern for most folks, but markets are now pricing a 67% chance of a rate cut in December. And if that happens, we can expect another wave of refinancing activity in both residential and commercial markets. From the liquidity perspective, long-term stability remains uncertain, but short-term stability is increased. So inflation risk, if it persists, it could pressure rates upward and asset values downward. So that's something we want to avoid. Now, from your investment strategy, investors should monitor repo rates and treasury issuance as well as commentary, because really they foreshadow any shift in lending conditions and market sentiment. So watch the news. The bottom line is the Fed's 125 billion cash injection isn't meant to spark a boom, but it's meant to prevent a bust. So for now, the banking system gets breathing room and the financial system gains a buffer. But commercial real estate investors would be wise to stay nimble, diversify their liquidity sources, and anticipate potential shifts in capital availability. That, my friends, is it for the day. You can reach me at my website, HoustonRealEstateBrokerage.com. Hope you have a good one.